And good afternoon, everyone. My name is Jeff Tesch. I'm CEO of RCN Capital. So great to be back with you today, hosting an REI Inc. panel. A big thank you to our REI Inc., the magazine. Suzanne and Robert have done an amazing job, put together 3 panels today that are going to delve into all things real estate investment, bring us up to speed on where we are today, and most importantly, all you investors out there, have your pens, have your laptops, have your tablets ready. We are going to have ideas on where we are and how to make more money going forward. Our first panel today is property management and the path forward. And we have 3 outstanding experts in the field. Nikki, I'm going to start with you from Five Brothers Asset Management Solutions. A little bit about yourself and your company. Hi, Nikki.
Hi there. I'm president of Five Brothers Asset Management Solutions, and we essentially do default services, REO services, and that would be preservation, inspections, maintenance, repairs, all of that.
Well, thanks so much, Nikki. Look forward to a great conversation today. Next up, we have James from Tennant Turner. James, good to see you again. Welcome aboard.
Yeah, thank you, Jeff. I appreciate it. Yeah, James from Tennant Turner. What we do is we help provide the lifeblood of leasing for property managers. We generate tenant leads, we get them pre-qualified, scheduled, and really in this post-pandemic world, helping people get over the hump of in-person showings through self-access technology and virtual in-person tours.
Fantastic, James. And finally, Greg, how are you? Good to see you again from Renter's Warehouse. How's it going, Greg?
It's going great. Thank you. Happy Monday. Thanks for having me. I'm the Chief Strategy Officer of Renter's Warehouse. We're a full service property management company in 40 MSAs around the country. And I'm responsible for the institutional group and the professional group we have a wide array of clients ranging from folks that have 1 or 2 rental properties to institutional clients that have thousands. I focus mainly on the institutional, on the investment sales, and then segue to the property management side. So it's an interesting time to be alive in the SFR space.
You got that right. More demand, we need more houses. That's the theme. So with that said, Nikki, I'm going to start with you. And I know a lot of processes have changed. Maybe take our audience today through how your firm has changed and what ideas you can share with how our investor base that's on the call today can really delve into some of those changes that you've adopted.
Well, with the onset of the pandemic, obviously a lot of our processes are, everybody's working from home, obviously. So we had to gear up for that and, really move 200 people to the work from home environment. And so we've had to really make some changes with respect to our ability to transmit the information and also just kind of expedite that information as much as possible, trying to account for what was going on with the pandemic, with people, actually vendors in the field truly being sick, having their limitations and all of that. So it was a little bit more, up to the minute kind of situation for us. And so with that came a lot of really IT development, security, that sort of thing, to really make sure that we were protecting our clients and the information. So it was all hands on deck very quickly.
Makes a lot of sense. Now, you mentioned the vendors there, Nikki.
Yes.
And as a national lender, we deal with investors from coast to coast at RCN. And one of the complaints that folks readily admit to us is, I'm having a ton of trouble. This would be our customers talking to us.
Right.
Ton of trouble with vendors, contractors. I can't get enough of the subs that I used to be able to get pre-pandemic. Mm-hmm. You, as a national vendor who managed these sort of subs,
Yes.
What are you seeing, and maybe some best practices for our audience today?
The struggle has been real. Certainly, there have been, first off, we know that the moratorium that's been imposed has really brought a lot of the services that our vendors generally were providing to a halt, right? So people kind of bailed on, on this whole job. So we've lost vendors for sure. The other important thing to consider is materials in general are very expensive compared to where they were. So between the fact that the volume is low, that people were getting paid essentially with unemployment or something of that nature, the pandemic, having their crews get sick, I mean, it really has been a struggle. But interestingly, what we found is that, the vendors who have made a career out of this business, they wanted to work. They were willing to work. They're willing to make the drive to go farther than they normally would. In all fairness, we'll pay trip charges to try and accommodate for someone driving the extra distance. But so you kind of have the career vendors in the field, and then the subs, they come and go. So there have been some real struggles, there's no question, but there's still plenty of people that want to work.
Sure. Greg, I want to pivot to you real quick and talk about this topic of not enough vendors handling the work that needs to be done on the existing single family inventory. You have a wide swath of the US with Renters Warehouse. Where are you seeing challenges with vendors, and how are you overcoming them with such a big footprint?
It's real competitive out there, right? And so one of the initiatives that's underway right now is to put the finishing touches on a vendor portal to give us that technological advantage to be able to know which of our vendors are nearby, to be able to put something out very quickly. Last year, we launched mobile portals for our tenants and for our owners. And so those have gotten a lot of traction where, okay, a tenant's got a problem with something in the house, takes a picture of it, submits it in, and it fires off directly to the owner, who has the ability to approve that, rather than having a central department trying to reach them to get approval. And so it fires off pretty quickly. And now we're adding the third component where tenant shows an issue, owner approves the issue, and we have a decent percentage of them that are getting approved in like instant. Like imagine your phone pings, you look down, you're like, yes, or in this case, actually, it goes out to a vendor gives the estimate, owner approves the estimate. It just tying all the different parties together has made it easier for us to get things done quicker, and to have the vendors get caught less in a ping pong match of yes, no, wait for it. If they're out at the house, they want to get approval to do the job while they're out there. And so we put a lot of energy and a lot of money into that mobile tech to tie. It's like a three-sided platform that we're in the middle of. And that's been showing some really, really solid signs of making the vendors happy to do our jobs, because it's easier to work on our stuff. Well, then it's easier to work on our stuff than it was 2 years ago. Yeah. And that's an accomplishment, so that they keep their eyes open for that app to start firing off opportunities for them.
Yeah, my guess would be having a vendor base that is loyal to you, to your company. Yep. It's got to be worth. You can't even put a price on it.
And our maintenance department considers the vendors to be their customer in a way that maybe people wouldn't assume. That obviously the customer is the customer, but if the vendors are treated like vendors, second-class citizens, then the customer suffers. And so they've got a mindset that the vendors are to be taken care of, and that's the leadership of the department kind of leads with that message. So get them paid as fast as we can, make it easy for them, provide them with technology that they don't have to pay for. We want to give you money, please accept our money and get the job done quickly, but we're going to treat you like a customer at the same time.
Yeah, I love it. I mean, we see that at RCN all the time, which is our repeat customers, right? Like their whole business, whether it be aggregating single family homes or buying, fixing, and selling. The most sophisticated investors who have a relationship with their vendors and pay them a premium. Pay them a premium. Those are the ones that are most successful, because that loyalty, it's just amazing. So James, I really want to get to you, because some of the technology, and Greg, you were talking about yours. I know, James, some of what you've been doing from showing remotely and really stepping up your game during the pandemic. Maybe talk us through how that looked during, and then adoption post-pandemic, not going back to some of the old habits that we all had before.
Yeah, habits, that's a key word there. You know, we all got into these various routines throughout the pandemic that changed where we work, how we work, what's virtual and what's not. And we definitely saw that on the leasing side of things, where on our platform where we generate leads and coordinate showings, we generally saw a 50-50 split. 50% of people were doing in-person showings where a leasing agent would meet them at the property and take them around. The other 50% of prospective tenants, they were getting access through an electronic lock or lockbox and being able to go on their own after we did some verifications of their background. Then obviously the pandemic hit, and some leasing agents, property managers just outright stopped showing property. Some because that was a requirement. It wasn't considered an essential service, and so certain state governments mandated that those things just went to a complete halt. So we saw a significant uptick in people who are curious and interested and needed to leverage more technology to allow people to go view the properties. As you guys know, with third-party property management, or even as owner-operators, this is a business, and if there are not tenants who are moving into the properties, there is not rent being collected, and there is not money being made. So, pandemic or not, this part of the process had to happen. And so we saw a steady increase, and it went from about 1/3 of our customers to 60% of our customers who actually started utilizing self-access. The number of showings went from 50% of the showings up to 80% of the showings, went from self showings to self showings, basically the pretty significant jump there. And that, and then we saw more and more people adopt the concept of like a live virtual tour, where a leasing agent might still go to a property, but via FaceTime, Duo, or technology provided by Tenant Turner, they were able to show the rental to a person without them physically having to be there or put themselves in any sort of harm's way.
So let me interject there real quick. So adoption from the customer, did they like having that virtual showing with someone there with them virtually versus the, just kind of the walkthrough, self-access? What's the feedback been there? That would be interesting to our customers today.
Yeah, it's really interesting. So any slow adoption to self showings has been around people still wanting to provide a personal touch and be able to connect with that prospective tenant and really get their questions answered, be able to do that in person, and provide that customer service that they want to set the tone for the rest of the relationship. With self showings, you gain significant efficiencies. You do more showings in the evening, more showings on the weekend. The person can go on their own and not feel pressured, which is great. But then there's still a lot of folks out there who want to have that personal connection with a prospective tenant, and those live virtual tours help kind of bridge the gap. It was still an appointment, but it wasn't one that was so aggressively coordinated that you had to have two people at the same place at the same time. And obviously in our industry, no shows are a real Achilles heel. And so with this, the prospective tenant never had to go to the property. They could do it from home, feel safe, but ask their questions. Especially as you guys know, the leasing landscape changed significantly because everybody's working from home. There's now questions: how big is your pantry? Where am I going to set up my home office? It's not just, is it a 2-bedroom? So things changed, and people were able to kind of ask those questions and do it in a live conversation like we're having right now, versus even like those pre-recorded virtual tours. We've all seen those, and those have their place in the industry, and they're very valuable, especially those that can be more involved, like a Matterport tour. But at the end of the day, you're not seeing the inside of the pantry. You're not seeing where you can put your office desk. You can't go back and kind of look around the outskirts of different areas. And that's what people do when they do a real in-person one-on-one showing.
Are we going to go back, or is it here? Like, is this the new way?
Yeah, I mean, I think it's another tool in the toolbox, like so many things. And Appfolio, they did a survey, and about 70% of property managers said those live virtual tours are here to stay. And as you can imagine, it creates some efficiencies for the organization, but still allows the person to see the property in detail and ask their questions. So it's a really nice hybrid. But I also think those self showings, we saw it tip over 50%, and I don't think it's going to ever go below that again. So I think that's definitely something that's here to stay. I certainly think over the next few months to a year and a half, we'll continue to see those live virtual tours. But we'll see. There's people itching to get back out there, and those folks out there, leasing agents, property managers who love that human-to-human interaction, they will want to get back to that place of doing in-person tours. But is the day of the open house dead? Probably. There's just so many other options that are out there for people to go see these properties now.
Yeah, makes a ton of sense. And Greg, your company certainly has, as I mentioned earlier, a huge footprint across the United States. And really, your business is dealing with professional investors across the country. Your platform, acquisition of asset, acquisition of tenant, and then of course managing it. So really an end-to-end solution. Maybe give us an idea on how the professional investors today are changing their business model. Like what are you hearing across the US?
It's a great question. One of the things that is absolutely true this year is that there are people that are coming into single family investment for the first time. Right? If you own a bunch of office buildings, you're thinking that you wish you owned more houses, given that that's where folks are going to work and shop, et cetera, et cetera. So we always expected that as the institutional players that came into the space a few years ago that went public, you'll recall that there are people that doubted whether you could ever manage scatter site properties effectively. And there were some doubters that were proven wrong. And the big players are so transparent because they're public, so you can see their NOI. And it was on its way to becoming a new commercial asset class for institutional capital, where it was going to open the floodgates, where pension funds and insurance companies and family offices were going to diversify in all the different food groups in commercial real estate, including SFR. And then COVID hit, and then it accelerated. A lot of people are feeling, where they kind of looked at houses as something beneath the commercial investors' sort of wheelhouse, and now it's not. It's showing itself to be super resilient, and with that, people are coming in with completely diverse strategies. Okay, so the first wave of institutional investor, it was the same 12 cities. They all wanted the same 12 cities. It was based upon a lot of the same main migration patterns and demographic shifts that were taking place. They were all right to be picking those cities. Those were solid strategies. But now we are seeing people that own property in the boroughs outside of Manhattan who want to own single family properties outside of Manhattan. They don't want to make a leap to Dallas. They're New York investors. Okay, so we have a portfolio in the Pocono Mountains, which is 2 hours west, that we're marketing. We've got a portfolio coming out because we focus a lot on whatever different sources we can for inventory, especially now. And occupied rentals are an interesting animal because a lot of people that own occupied rentals think the only way to sell them is to vacate them first and sell them the traditional way, where selling them in a package of 57 is actually really attractive to the buyer, and selling them occupied is really attractive. And so a portfolio is coming out in the suburbs of DC. DC and Eastern Pennsylvania weren't on the radar of the institutional SFR space. And so now there's a really rapidly expanding institutional, but a very rapidly expanding entrepreneurial class, professional class of investor who, when they're all done, they may have 100 properties or 75 properties or maybe 500, but it's not going to be 20,000. But they're all over the map in literally where they want to be, what they're interested in. 1031 exchange buyers who want to put it into houses and they're willing to accept a lower yield than what the institutional players are willing to accept because they want to save on their taxes and they want to buy quality because they're banking more on appreciation, letting leverage and appreciation do its work over time. There's just a lot of different thinking than what was kind of a myopic approach to SFR for the last 10 years by the big players. It's now getting really interesting, and it gives you a chance to be creative and to share ideas and to take a package of properties and tell the story about the package and attract an investor who wasn't thinking about the Pocono Mountains, for example, but now, being 2 hours out of New York makes sense to them. And as a result, there's a group touring it tomorrow that wasn't even thinking about it, but the story made sense.
I saw your interview that you posted on LinkedIn with that owner, by the way. Nice job with that.
Thank you.
Really interesting to hear the story of aggregation.
Yeah.
And let me give you a follow-up question for that. I'm sure there's a lot of investors on the call today, Greg, that want to take that next step. They want to feel comfortable buying properties that they might not be able to drive to in the half hour or hour that they're used to. How do you have that conversation with folks, and how do you make them comfortable?
That's a good question. I mean, well, first of all, you show them that they could buy a house for $125,000, and they're from a place where the average price is $950, and so that's a starting point. And the taxes on the $950 house are $35,000, and the taxes on the $200,000 house are $1,900. So they get more comfortable when a national brand is one of our advantages, right? To the extent that we're not exactly national, because there are places that we aren't, but that helps. If you're in Seattle and we've got a branch in Seattle, but you want to buy in Dallas or you want to buy in Phoenix, you're meeting somebody in Seattle who's introducing you to their colleague down there. And that's always been something in residential real estate. The sales side of residential real estate, national brands have always been able to sort of create that perception of there's somebody local to kill if something goes wrong, Like I met somebody face to face, there's an office, what's the phrase, that a throat to choke, right? It's not something in the cloud. There's actually a human being that you can yell at if something goes wrong. And that's what they're worried about, something going wrong and them being nowhere near it. A lot of people are actually coming to terms with the idea of investing further away because they get turned on by the ideas like, I'm a New Yorker who sees everybody moving down to Florida and the Carolinas, and I get it, right? I understand the story of the migration trend. I understand how that migration trend's accelerating with COVID. It may ease up again, probably will in the future, but it was already happening anyway.
Sure.
And so this is like something that wasn't foreseen. It just got accelerated. They also have a comfort zone. They want to retire to Florida. They go on vacation to Florida. So that winds up being a big thing. My primary market is I live in San Francisco, but I've been going down to Vegas on weekends my whole life, or I've been going down to Phoenix for vacation. So now I get a chance to visit my portfolio when I'm down there. My folks live in Texas. I mean, there's all kinds of reasons why you've got your primary place where you live, and then your secondary places where maybe you went to college, you've got family, whatever, and they wind up having a comfort zone there.
Yeah, and I think that's really well said, which is when folks are thinking about making that step, maybe you don't necessarily have to make the step to somewhere where you haven't been before, but you already have that comfort level, and that's where you begin investigating. I think that's a great point. And Nikki, I've got to come back as we're talking about folks being distant from their properties. I just keep coming back to technology and the ways that property managers are giving that comfort level to the owners who aren't close by. And a lot of it's safety, but a lot of it is just a better way to do business. And I know it certainly at Five Brothers, you have made a lot of changes that are here to stay. Maybe talk to our listeners today about the ways they should be thinking and some of the things that you've put into your business model that everybody should be thinking about today.
Well, certainly in terms of communicating the condition of properties, that sort of thing, certainly no different than, what James and Greg have been discussing. We have drone technology now. There's video technology to communicate along with, photo technology, of course, digital metadata, that sort of thing. So the reality of the situation is really the only limiting factor in terms of how a client might want to receive the information. Certainly, there's no limitation for us in terms of our ability to provide a video link or something of that nature. Storage is sometimes an issue for the client or the investor in terms of, how much they they actually want to receive. But that is really the wave of the future as far as that goes. So, you know, a picture is worth 1,000 words, a video is worth, you know, 2,000 words, honestly. So I do feel as though, I mean, the way we do business in general, I don't see it going back 100%. The same thing with respect to the work from home environment, that work-life balance, just commercial space for your employees. I see, you know, a hybrid going forward. So it's very interesting because I think that this cycle has lasted so long that what was new now has become something that we've all gotten used to. It wasn't a 6-week period. It's been, you know, well over a year. And so we're ingrained now into this way of life. And I personally don't see us going back 100%.
Yeah, I would agree with that. And
Yeah.
James, I want to take that same question, but maybe pivot a little bit and think about the investors that are on the call today who maybe haven't taken that step to embrace technology. Maybe that they're not considering doing the distance ownership, right? They're comfortable with the portfolio that they've built out locally, but maybe they want to grow that portfolio and they're considering management. And maybe you could just talk about why it makes so much sense to embrace some of these changes that you've made in your model and how the end owner of these assets would really benefit from them.
Yeah, and I think you know, I use the term that Greg brought up. It's that kind of scattered, you know, scatter site management of portfolios. If you know, I'm in Richmond, Virginia, and we have our urban center, and a lot of investors have a thesis that they invest in Churchill or Scott's Addition or Manchester, these different neighborhoods, and that's where they live and that's where they operate, and they can reach out and touch their investment. But then on the flip side, you know, there are other buyers that come in, inventory gets reduced, and then you got to go look someplace else. And whether it's a different city or a different region, or even in your same metro, but just on the other side of town, you have to come up with a new thesis. You have to continue to reinvent yourself. And for these investors, we're starting to see where they're looking into that next new neighborhood or that next new neighborhood. And it's not all going to be urban. And we see this shift now where employers are saying, look, you can work from home until end of 2021, indefinitely, for forever. So people can start to live wherever. And we're starting to see more and more folks looking for more space because their home is, again, not just the place where they sleep at night, it's the place where they work and do virtual school. And so they need more space, which is making the suburban areas more appealing to renters. So we're starting to see that shift into other areas outside of urban spaces where it's not as easy to just look out the window and see your investment property or go down the block and actually, you know, knock on a door. And technology is helping people do that. So, you know, just as much as nobody else wants to leave home anymore because we've all gotten very accustomed to working from home, the investors shouldn't have to either. Go put a smart lock, go put a smart lock box on a particular property that's, you know, maybe 30 minutes away, and leverage technology to grow your portfolio in a way that you feel comfortable.
Yeah, I think that's well said, because I think especially seasoned investors, as seasoned investors have begun to think about growing their portfolio and have said, and they just have a mindset, well, it's always worked this way. Why do I need to spend X dollars to adopt this technology? Maybe you could talk a little bit and say, you know, the return on investment, and this is why you want to do it.
Yeah, and I mean, I think the return on investment with any great technology, you know, it's going to be really high. But with software, I've always been a software person. It's always hard to quantify. I remember, you know, many moons ago, I used to build HR software, and we used to say, okay, well, it costs 0.003 cents per piece of paper, and if we digitize the online, you know, the application, we can save this much. And you know, everybody's always looking for those hard cost savings. And then you look at it, it's like, well, it's really, you're not really saving that much. Well, the savings comes in efficiencies. The savings comes in minimizing the distraction. The savings comes in the reporting that happens downstream because you're tracking technology. It allows you to scale without adding that extra leasing agent, property manager, or additional staffer. So there's all those different things. And where it might be hard to quantify some of the value of software. Where software is really easy is you can generally try it. You know, you can try technology. It doesn't matter what it is, an inspection app, a showing scheduler, or whatever. You can generally try any sort of software and do it in 30, 60, 90 days. Give yourself a quarter to try something new. If you ever had an excuse to try new technology, this pandemic has given it to you. You've earned that right. Try some stuff out. If it doesn't pan out, you've put out very little money. You've learned a little bit about yourself and what's out in the market, and you'll be a better person for it.
Love it. Folks on the panel today, we do have the ability to be able to have some questions answered. Please go ahead into your question box on your screen and type in any questions. We'll leave a minute or two at the end of the panel today to hopefully grab a couple of questions. So I'm going to put out a question to all our panelists today, which is certainly something that we've seen post-pandemic, well, we're not post-pandemic, but certainly post-middle of the crisis, which is this flight to the suburbs. And, you know, Greg, I'm going to start with you. You've got a huge footprint across the US. What are you seeing from investor appetite on this flight to the suburbs? Or do we expect a retrenchment closer to the urban core that was certainly all the rage pre-pandemic?
Yeah, I don't think people change. You know, I always thought it was very interesting when we read article after article for years about how millennials don't want to own homes. Millennials don't want to live in the suburbs. But then the next article would say they're also going to live to 105 and they're taking longer to settle down and have kids. And I know that you go from how far are the bars to how good are the schools like that when the first kid is born, and they're just people and they're just going to do what everybody's done before them. And they have, right? So it goes back to this idea of COVID being the great accelerator. Demographic trends, migration patterns, all these things, employment trends, working from home, all these things are just happening so much faster than they were. Having said that, though, I think the cities are going to become popular again. You know, I grew up outside of New York. I don't live there now, but and so what concerned me is New York going to have a lost decade as a result of this. They got hit the hardest. But something really interesting happens in the fall, and that is that Facebook took a $500,000 roughly office lease. All right. You think about that. Now, what does that mean? Well, that means that Facebook clearly wants to hire as many smart young people as they can and wants to give them a place to work, wants them to come into the office. They wouldn't be doing that otherwise. It wasn't just about getting a steal on office building. It was about wanting to be New York based and have a lot of people there in what's basically a vertical corporate campus. But you're also talking about a company that has a lot of influence about when people are going to feel better about going back to the city. Right? I mean, Facebook has the ability to decide that it's safe and then to persuade tens of millions of people that it is. And so that may be a leap. It's not a conspiracy theory, but it may be a leap. But you look at that move and you say, like, I expect, for example, this summer for rooftop pictures of rooftop parties to be trending on Instagram a lot if it's safe to go to one of those things. They have the ability to let people know that it's okay. And a move like that from an entity that powerful tells me that that folks are going to wind up, when they feel good about it, going right back to some of the things they used to value, like living in an urban environment where the city never sleeps.
So we got one vote here, folks, for old habits die hard. I can't disagree with you, Greg. I think people are social. Nikki, what are you seeing? What are you thinking? How's your organization planning?
Well, I can tell you at the beginning of the pandemic, and certainly we have, you know, a lot of families that are employed here, and everybody was very happy to be working from home, feeling as though they were hands-on with their children. They could still meet their responsibilities. They didn't have to deal with the commute. And today, what we have are phone calls. When can we come back? I've had enough of time at home. I got to get away from my kids. I'm ready to come back to work, you know. So, I mean, it might have been nice for a period of time, but a steady diet at home all day, every day with your family can be a bit much. So I do feel as though people are going to be grateful to go back to work when they can. I still think a hybrid might be the best answer for people, to have that little bit of balance, which I personally am a lot more receptive to that than I would have been pre-pandemic. So I've always felt like there's a certain amount of difficulty that comes from management, when you're not under the same roof. And I don't feel that way anymore. I mean, people understand the value and everybody works together, and it works. It's worked fine, but I'm sitting in my office right now and I'm happy to come back to work. And I think others will be as well.
Yeah, one of the things we, as a national lender, we've always thrived on that energy that the office brings, right?
Yeah.
Like, so our team here, we're in Connecticut outside of New York City. Even though we're in a somewhat of a suburban setting, the energy that was always created in the office, that's what the employees have been asking for. And we've actually used the time to begin a renovation on the office when folks aren't here. We started planning it 6 months ago. We're just about ready to start construction, and we expect by the fall to have a whole new look that hopefully the employees will be excited about.
It'll be very well. Sure.
Yeah, I mean, we think that hunger for folks to have that human connection, Greg, to your point, it doesn't go away. It just doesn't go away. James, I'd love to hear your thoughts.
Yeah, I think it's going to be really interesting because I think before there was a way, everybody went to work 9 to 5, and that was like the only way. And I remember working for different companies, and the innovative ones thought about the future of work, where there was technology that enabled people to work more remotely. And well, the future is now. Like, everybody has that. And now the only way isn't the only way. There are other ways. And here in Richmond, there was a great example I read over the weekend. Owens & Minor, a big healthcare distributor, had a couple of floors in a big high-rise downtown, and so they relinquished that mid-pandemic sometime last year. Well, now CoStar, who is a big in real estate around data and a commercial and residential and apartments.com, all these different things. They're another big Richmond employer. Well, they came in and gobbled it up. So yeah, there's some people who are saying, look, we're gonna do the work from home thing, but then there's other people who are coming in and they're taking those spaces over. And I do expect that particularly the people that CoStar is looking to hire, they're going to want to live downtown. They're going to want to be near the river. They're going to want to be able to walk and ride to work just as they did before. But it is going to be interesting to see what the mix turns out to be, how it all shakes out after a while, because before it just felt like there was a singular path to what you did as a business, what you did as an employee. Now we all have to think a little bit more. Do we want to be a work from home company? Do we want to be a hybrid company? Do we want to bring everybody into the office? And I think, to everybody's point, there's a lot of people who've been working from home. They're itching to get back into a space, but do we want to get back to a 5-day 9 to 5 thing? I don't necessarily think so, but if you're at work 3 days out of the week, you still may want to be near work. You still may not want to commute, and you still may want to work there, which is going to help those downtown apartments.
Yeah, absolutely. And I think that's very well said. Thinking through how your business is going to plan for it is going to make all the difference in the world. And I think setting the plan in motion with certain dates when it's safe to do it will get us there. And I think that is going to be the true testament to where we're going. With that said, we are out of time. I can't thank all of you enough. Nikki, Greg, James, fantastic job. The information for our listeners today will help get them a jump start on where 2021 is going and help them plan for the future. Thanks so much. Next up, our next panel at 40 minutes after the hour will be funding strategies and how to build your portfolio. Look forward to joining you there. Thanks so much, everybody.
Thank you.
Thanks, guys.
Fantastic. And welcome back, everybody. We have aggregated the best and the brightest, and we are going to be talking about funding strategies on how to help build your portfolio. Thanks so much for rejoining us today. And this is really an all-star panel. I'm so excited to have everybody on board here. I'm just going to have everybody jump in real quick, give a little bit about yourselves and your company. Nathan from Quest Trust, let's start with you. Nathan, howdy.
Hey, how are you? Thank you for having me, Jeff. I'm Nathan from Quest Trust. It's pretty simple. We just hold private assets inside of retirement accounts. A lot of the assets a lot of people like to choose are loans. So a lot of people are funding a lot of real estate deals in different ways. from trust accounts, and that's what I'm doing here. Either they're borrowing money or they're funding into a syndication of somehow. And thanks again for having me, Jeffrey.
Great, Nathan. Thanks so much. Jennifer from Mortgage Venture Partners. So good to see you again, Jennifer.
Hey, Jeff, it's always good to see you, and hi, other panelists, seeing as we're in this fun remote way instead of sitting next to each other. So I run Mortgage Venture Partners. We're a closed loan conduit aggregator. We buy both residential and single family rental assets, and that is what I do. We're going to have some exciting announcements coming up in the next couple of weeks, so watch for those.
You're going to make us wait again?
I'm going to make you wait, Steve, but you'll enjoy it when you see it, I promise.
I love it. I love it. And Steve, so good to see you again from Arbor. How are you?
I'm great, Jeff. Thanks for giving me the opportunity to be here today with all you guys. So I'm the Chief Investment Officer at Arbor. We're a publicly traded REIT on the New York Stock Exchange. We are the largest lender, we believe, in the build-to-rent space. I'm happy to be here to speak about it. We have a prolific multifamily lending business, asset management and servicing business approaching mid-20 billions, and there's a lot to talk about.
Fantastic, Steve. And finally, Charles from PIP Group. Charles, always good to see you.
Always good to see you, Jeff. Appreciate you having me. So I'm Charles from PIP Group. I'm kind of the black sheep from the panel here with more of the boots on the ground. We utilize self-direct IRAs and private equity for on behalf of our investors, flipping real estate, new construction these days as well.
Charles, none of us would be here without you. Let's be clear about that.
What's that?
I said none of us would be here without you.
Right.
Without the boots on the ground, right?
So we're in the Southeast, and we'll talk about it as we get through this panel, but business is booming.
Fantastic, Charles. Thanks so much. And finally, my name is Jeffrey Tesch. I'm CEO of RCN Capital, nationwide platform for single asset investments in all things, not only bridge, but also long-term rental, as well as multifamily bridge, new construction ground up, as well as multifamily long-term debt, nationwide platform. And once again, good to see everybody today. So Charles, you mentioned IRAs. Nathan, I would love for the two of you to talk a little bit about pandemic. What's that done to folks thinking about how they are investing their IRAs? Nathan, maybe talk a little bit about whether things have changed, things people should be talking about. And Charles, I want to have your input because you really are seeing what's happening, especially as you referred to boots on the ground, and how people are putting their dollars to work. I really want the investors on the call today to be thinking about how they can maybe pivot and change the strategies that they're using. So Nathan, take it away.
Man, I tell you, that's a tough question to answer because when I looked at my accounts, and we got a pretty good view of what's happening in self-directed world, because a lot of people doing a lot of different things. And when it first hit, it looked like a 3D pool table. You know what I mean? Balls going in every direction. You couldn't really figure it out, but a lot of things have been going on. One thing at this point, as the smoke has cleared, the unusual thing that has occurred is a lot of money. There's a whole bunch of money sitting in cash. And at first people were taking money out of their retirement accounts and other things, but I think a lot of people got paid off over the last 12 months. I know a lot of my investments ended up getting paid off, unusually not. And right now there is more money chasing private investments than I've ever seen in 30 years of doing this.
Interesting. And Charles, with those IRA dollars getting input, maybe talk to our investing community today, like what's happening and how it's actually occurring today, boots on the ground style.
So yeah, I would agree with Nathan. Everyone kind of had the, cautious wait and see, and then it was just like the floodgates opened. And remember, we're still in a moratorium as far as foreclosures and evictions go. I was reading something today, actually, it says that Fannie Mae's extended that another 6 months, it looks like. So people are just jumping after real estate as quickly as they possibly can grab it. So I'm with Nathan. Things are crazy right now. Crazy good, but crazy.
So Nathan, Charles, when people are thinking about putting their retirement dollars into that IRA vehicle, how do they get over the hump of deciding, you know what, I want to go the self-directed model. I want to begin dictating how I am going to use those dollars. How does that conversation go? How do people get to that place?
Honestly, it's really just a matter of education. 90% of people would probably do this if they took the time to understand that they can. We've all just been put in this box for so long that this is the way to do things, which could be dangerous because self-direction is a tool, and it can be very dangerous when it's used incorrectly and very powerful when used correctly. So most of the time, I'm just educating people that they can do something, and you got to find the thing that matches your niche. For me personally, I like loaning money because I don't like toilets and tenants so much. Other people might like rental properties or syndication or oil and gas or whatever it is. So once they find that niche, most people like to invest in the things that they know best, and you can do that through a self-directed account. I actually like people that have the balanced approach. In other words, they keep some of their money in traditional assets, some of their money in weird assets, and balance and move back and forth. And if you don't know something about something, for example, lending, use a mediator or somebody in between it. Like you can often loan directly to a mortgage company or hard money bank, and then they're seeding your money out. Sometimes that works really well for some investors.
And Charles, how do you have those conversations when people are ready to make that step into a hard asset?
So for us, usually they've already made that step. They've moved the money into an SDRA, or it's just sitting there and they haven't figured out how they want to deploy it. Gas and oil. Look what's going on with gas right now. We are real estate. I got into real estate literally as I was becoming an adult. Was the NASDAQ crash, and I said, you know what, I'm never going to be tied to the stock market. And I think it's like 89% of people don't even know that these SDRAs even exist, and that it's an option. Nathan, you probably correct me on that, but I know it's a really low number that people realize this tool is available to them.
Yeah, it's less than 2% of people actually self-direct retirement accounts, but I think that speaks to something that we could all benefit from understanding. Most people are paralyzed when it comes to their retirement accounts. Most people spend their entire lives taking their 401k statement and throwing it in the drawer, and maybe they'll look at it again next year. They literally stay paralyzed. And what a thing to be paralyzed about your whole life. Look at the people just on this panel and what they can offer to those people as investment strategies and things like that. It's just if we could get more people actively involved, what a social impact we would have on our society would be so immense.
Yeah, I think that's well said. And we see it at RCN, right? We see people coming to us saying, I have X dollars in my self-directed IRA and I want to use capital to leverage that instead of just straight up cash going into an asset. How can I leverage that? And there's ways to do it. And they're no different than a traditional investor going in. They're just using tax deferred strategies, which make a ton of sense, and layering some leverage on that within reason. And as a lender, we think about that, right? Like, we don't want people being over leveraged because we always think about it, worst case scenario. I don't want my customer being over leveraged. I want my customer being responsible. And, using that IRA is a way to do it.
If you looked at over the years, I've got these new systems and they really can track different levels of investments. And these are all private investments, like private stock. 1 billion% every year after year after year. What is the best category? Buy and hold real estate that's leveraged. Period. Single family is typically the highest level. It's just the best. It's hard to beat it.
So Jennifer, I want to pivot to you because, you have a real deep knowledge of financing and structures and what's happening in the investment community today. And there's a ton of folks on this call today who want to understand, am I doing the right thing? Am I using all of the levers? And how do I think about 21, 22, 23 going forward, what my strategies would be? What are you seeing out there, Jennifer?
So I think it depends on the investor, right? Are we talking about the guy who has, 10 or less properties? Are we talking about the more institutional guy? And are they really looking to invest in new real estate or go fix and flip or buy to rent, et cetera? And I think, that's a very important deviation. If you're a smaller guy, I think that, you have a really good opportunity right now to actually take advantage of starting to build your business to make it a little bit more multiple in size. Because what I think you're starting to see is a shift of the institutional buyer to build. And, I'm sure Steve can, definitely opine here. But, when you start to see the institutional investor that has 130, 140, 150,000 homes, think that the supply is not large enough for the new capital that they raised, which is true, they're going to start to shift to the build side. So what that does is it really opens up extra opportunity for the small to medium sized investor, in my humble opinion, to be able to come in and start to grow their portfolio off of the things that the institutional is not focusing on as much today. And Steve, do you want to give a little color on that? Are you seeing that in your business on the build side?
Yeah, you asked me, Jen?
Yep.
Yep, sure. We are actually seeing it. We've done construction deals where CrowdStreet has come in to provide LP equity, and two deals that I can think of in the greater Dallas area that sold out their equity literally in 3 seconds. So I think it's a global theme across all markets that things are breaking down, which were once limited to private equity types or coming to individuals, whether it's Lemonade, whether it's microfinance, whether it's other vehicles that give people more access. So to rally off what Nathan's saying, I think it is happening. I think there's more and more social networks talking about how you get different structured access that you never had. It's exciting times for the individual investor.
Yeah, look, guys, I think the other thing, sorry, Jeff, is people have a little bit more time at home, even though they have jobs, right? So I think it's given people a little bit of extra time to investigate things that they may not have had the time to investigate sitting in their offices or, depending upon what their job roles have been. So I think you've seen a shift toward a little bit more of a knowledge evolution at the investor level as well, which allows for that precipitated growth.
Yeah, and Jennifer, thinking about how the GSEs have maybe thought about investment properties in the past and the way that they're going to think about them in the future, both Jennifer and Steve, I'd love to get a take on where you think our good friends at the government-sponsored entities are going when it comes to the investor-sponsored loan programs. Jennifer, I'll start with you.
Yeah, I mean, guys, if you take into consideration that, if you look at Fannie's last 10K, they say that they are 28% of the total outstanding debt for residential dwellings, right? And if you take into consideration that they have been at between 8 and 11% non-owner occ and second home saturation, depending upon when it was at acquisition or at guarantee, and you could read this straight up in their public filings, by stubbing their acquisition percentages to 7%. What that does is free up anywhere from 1 to 4%, if you look at the last 3 years, of their acquisition percentage appetite on that non-owner occ and second home for everybody else to take advantage of. Now, keep in mind, Freddie, with the receivership, although they haven't put it out there yet, is going to have something similar. So is the way I look at it is there's 1 to 4% of 3.35 trillion up for grabs on opportunity, because that's what 28% of the $11 trillion housing market is. Steve, what's your thoughts?
I'm processing the numbers you just threw out, Jen. It's staggering. So I'll come at it from a slightly different angle. At Arbor, we focus on the multi-side of the world. And the multi side is trying to figure out how do they extend into the build for rent market. And it's a completely logical extension. 2 years ago, there wasn't one page in the guide on how you could or could not seek permanent financing. Today, as a top 5 lender to Fannie and Freddie, we do have active dialogue about where they'll take out a construction loan. What are some of the rough guidelines? Does it have to be one tax parcel? Probably better yes than no. Should it be amenitized? Probably yes, better than no, etc. And we have more active dialogue running in how those projects will receive long-term financing. And I know down the road we're going to talk about predictions to come on knowing you, Jeff, but I would say their presence will do nothing but grow in the build-to-rent space.
So, Steve, I would love to know, do you think overall the GSEs feel like the private capital market is sufficiently handling the investor space and they're going to pull back even further from what they have? Or is it going to be status quo? What are your thoughts there?
It's about as loaded a question as you could ask me. So my answer to that is pretty simple, which is they're trying to maintain their footprint. They're trying to maintain high credit quality. They're trying to figure out how to transfer risk. I don't think that there's a million committees inside the GSEs worried about investor per se. I think they're far more concerned with home ownership than they are with helping investors. With that said, over the last 3 or 4 years, there's been a proliferation of lenders that have stepped in to kind of fill the void. And I think it's functioning pretty well.
Yeah, I would agree with that. And Jennifer, maybe you could talk about on the private capital side, the flows that you're seeing away from the GSEs, and maybe what was happening during the pandemic and where we're going now with those private capital flows into all things non-owner occupied residential.
Yeah, so what I think is there's a good polar on this panel because Steve really focuses more on the multifamily and we really focus more on the single family, say 2 to 4 max side. And I think when you think about that, you know, when you look at what Fannie Mae just did, the opportunity really sits away from the multifamily side of things, right? When you're freeing up that and from a single family perspective. So let's put it into context, right? So there's 17 million units on the single family residential side that are rented, okay? 5 million have metamorphosized from owner-occ to rented in the last few years, okay? That will continue to happen, especially with this new exodus to the suburbs. I heard in your last panel, Jeff, you know, it was a very good point. And I think when you think about that, there needs to be differentiated types of financing to allow for that continued metamorphosis, even away from the larger portfolio looking assets. So I think the self-directed IRA is interesting. I think the buy to rent and fix and flip smaller lines and also smaller term portfolio loans are going to continue to get more popular. I think something we've had for a few years now that I think will gain significant traction more so on the non-owner occ second home side, although we've been a little bit more primary residence historically, is the first lien home equity line of credit that can be given for a purchase or a refi of your investor or second home properties as well, which allow for you to actually tap the equity in those properties to finance other properties or make other payments or do your next fix and flip, et cetera. So I think that you're going to see a lot more of that. I also think, you know, refinances are going to continue, but I think we're going to soon see, due to rate increases, a shift to people having to remember how to do purchase money. You know, it's been a really interesting few years with lower purchase money volumes, and now we've gone into this by luck pandemic sauce that allowed everybody to get super rich off refi in the more resi side of things. And you know, you sit here and you go, okay, well, let's make sure everybody knows how to do purchase money next. But I think that non-owner and second home feature, due to the restrictions that the GSEs are going to have, because quite honestly, they've also become non-QM lenders these days, also is really going to be an opportunity for the SFR player or the more nuanced financer that originates to a human borrower versus an LLC.
So I can't help but take the rate and leverage question because our audience we have a ton of end users on this call today. And one of the questions that everybody wants to know is, where are rates and leverage going from lenders? What's happening? Are we going to stay status quo? We're seeing the 10-year treasury rally, but maybe it's not rallying the way we thought it would. What's happening with inflation? I'm so worried. Should I be locking in today? Now, I just threw about 10 questions at you, Jennifer, but let's try and get to the point, which is, where are rates and leverage going from an investment standpoint?
You know, you always give me the hard questions, Jeff, you know? If I had my crystal ball, I could tell you, but I'll be honest, I'm a fan, and, look, we have some skilled investors here, right? And, if I were an investor right now, the answer is we don't know, because we don't know if there's going to be another lockdown in California. We don't know if they'll extend, the rental moratoriums. We don't know what the next impact could be at the moment, whether the state of Texas is lifting the mask ban or not, right? So I think if you're me, okay, and I'm buying my next property, I'm getting it with a floating rate, because it's going to go down and it's going to go up, and then I'll worry about it if it starts to really go up, right? And the reason for that is because of where you're seeing that floating rate asset today. I think that if you're going with a 30-year fix today, you can still do better yet. And I think that it's going to increase, but it's going to decrease. And listen, I've lived through 3 downturns at this point. Let's not include the pandemic. And the thing we see every time is the pothole effect in rates, right? It goes up, then it goes down, then it goes up, then it goes down, and then it eventually equalizes. And absent another pandemic, it will equalize to increase, in my humble opinion.
Well, there you go, folks. So I want to do a complete pivot and really talk about inventory when it comes to the lack of it, and what we're seeing from our investors today, which is a huge appetite for ground up construction, whether it be single family, whether it be built to rent, infill, larger projects. Charles, maybe talk about how your model is, what you're seeing, especially since you're such a big player in the Southeast, where demand is just off the charts. What are you seeing from the ground up perspective?
So yeah, we've had to kind of reinvent the way we do business because our business was based off of distressed real estate, i.e. foreclosures. So now we're starting to acquire a lot of the abandoned properties that are out there, but we're also building ground up. We're getting into larger projects. We're getting into historical properties in the Savannah area because, as you said, inventory is down. There's still a lot of opportunity in the markets that we operate in. And we were fortunate enough to be one of the biggest players in our markets that we operate in before this happened. So it's been great for us. I mean, I printed something off from February just in my own town, which is Hilton Head Island area. And 1 year change in closed sales is up 40% with a price increase of 20%. And that's just over the last 12 months. I would say that's probably over the last 6 months because there was a little time there that everyone was just kind of wait and see. So we're seeing things just go absolutely crazy. We just bought a bed and breakfast, which is new for us. So we're getting into a lot of different things because of the inventory shortage that's out there right now. But because we're not buying 100,000 properties and we don't operate in markets like Texas, we still have a really good handle on what we're doing. So we're steady. And we're able to sell these things for a lot more than we were before, but we've also got huge increases in the cost of lumber. So that's a 40% increase over the last year in lumber. So when it comes to building ground up, you got to take those numbers into consideration as well.
No question about it. And Steve, let's stay on the Southeast for a minute. And certainly Arbor has a nationwide footprint, but when it comes to the build to rent model, I think there's a lot of folks on our call today that are very interested in how it all works, especially from a financing perspective. Maybe you could kind of delve folks into thinking about what they need to think about, especially on the finance end, Steve?
Sure. Okay. A typical construction loan would be, call it 75% of cost is what we would provide. There are banks that would probably go to 50 or 55, but as the space is growing so fast, we're really finding the non-banks. Rarely do I compete and or lose with a bank. So of the 25 points of equity, we would look to see that acquire the land, the entitlements, and the infrastructure, roads, amenity center, et cetera. And then in an ideal world, Arbor's first dollar goes to the vertical construction. Now, Jen would tell you in a fast second that 25 points doesn't get you that far, and she'd be right. So inevitably, on the 75 LTC structure, we do some completion of what we would call the horizontal pieces. But in general, the equity's deployed first, Arbor dollars come in, projects get built between 20 and 30 months, say twice monthly draws, and we're constantly moderating the construction piece and the lease up. But the thing that's most interesting to me as a lender in this space and why Arbor likes it so much is, unlike in multifamily construction, where you're going up 30 stories, you're building 250 homes in groups of, say, 25 or groups of 20. And so as the land is built out, you have 2040, you're starting to lease the first 20. So you have real-time feedback on your future value, which is unbelievably valuable. And as that happens, you're seeing builders start to get a better sense of what their value creation is. So on a 75 LTC loan, we might look to say, we'd like to see 65 of value at the end of the day. And frankly, the projects are far outpacing that. And which is leading to other interesting developments, frankly, where you're seeing developers sell off units at CO. And we finance the buyer of those units. So now you're on both sides. So it's a wonderfully interesting space. And we're excited to be a leader in it.
So Steve, for the investors on the call today, especially the more sophisticated investors that have begun to really build a decent sized portfolio through existing aggregation, and they're thinking about taking that next step. They're thinking about, you know what, in my community, I know there's some maybe areas of their communities where 20, 30, 40, 50 unit build to rent subdivision makes sense. What are you looking for in those initial conversations? And how do those conversations go? What are you looking for folks to bring to the table to you to start those financing questions?
Sure, that's a great question. So first and always, it's the old adage, but it happens to be true. We're looking for the location. Is it in a prime area with good schools? Because we feel like that's the market. Families are leaving multi, or they're even selling their real estate because of how high pricing has, and they're renters by design. They like the school district. We have a project in Fort Mill that looks just like that, best school district in the outer Charlotte suburbs. So number one, the location. Number two, who's the builder? What have they built traditionally? Have they built single family homes? We've got, we transact with large, what I characterize as top 5 public builders, all the way down to regional builders. Do they understand the supply side? Charles brought up the lumber issue. It's a major issue. Can you actually lock in what your costs are? Do you have the sophistication and experience to manage a project that's going to last 2 to 3 years? And then last but not least, what is your long-term vision for your project so we can better understand your financing needs? The financing really does come in 3 parts. It comes in the construction piece that we covered, then that there's a takeout to that of a bridge loan where we'll allow the builder to repatriate equity, stabilize, and then the perm financing. So trying to better understand, what Arbor doesn't want to do is be caught lending a spec builder. We don't want to finance 250 spec homes. Although right now in the Southeast, that's probably a winning strategy if you can find it.
If you can find it, there's the caveat. Absolutely. Yeah. It's interesting because we've been doing infill ground up construction now for a while, and it's just amazing the way it's taking off. As a lender that always really focused on existing inventory, whether it be buy, fix, and sell model or the rental aggregation, which is well documented over the past 3 or 4 years, and it's grown to be almost 50% of our origination in RCN now. It's amazing to see, and I want the investors on the call today to be thinking about this, is thinking about your strategy going forward. It doesn't have to be an all or nothing model. And we're seeing this at RCN, which is many of our investors are saying, you know what, I'm still aggregating single family inventory. I'm still building out my rental portfolio, but I'm also seeing these opportunities for infill ground up construction in the markets that I already service. And we're seeing that across the country. So in other words, it's just not the super hot Southeast. We're seeing it in Ohio, in Greater Columbus. We're seeing it in Kansas City. We're even seeing it in places like Oklahoma City, where infill ground up construction is making sense because of the appreciation that we've seen. And Charles, I think you touched on this, which is diversification, right? It doesn't have to be just one strategy.
No, absolutely. I was fix and flip for a lot of years, but seeing these changes, we got into buy and hold a few years ago for ourselves, and then for our the investors that we represent. And right now, I love the buy and hold strategy. I mentioned that we're diversifying ourselves into it's an 1854 mansion. That's a bed and breakfast with a restaurant underneath it. Quite honestly, the rents, I don't know what they're going to do, but the appreciation on it, without touching it, is going to be more than 12% a year, for the next 5 years. So that's the kind of things that we're getting into now, as well, as inventory continues to decline. And you find new strategies and new things to get into. I mean, everybody was all about the fix and flip, whether it was Joanna and Chip that got us there, or the opportunity that got us there. But those are not necessarily drying up, but the inventory is going down. So you gotta kind of look at the idea of multis, and maybe you get into a 6-plex or a 4-plex when you really didn't consider that a year ago at this point.
No, it's well said. And our existing customers, there is still, and I'm sure you see this in your communities, Charles, there is still such a huge amount of aggregation that can be done on both sides, whether by buy, fix, and sell or rental, because of the state of the housing that is in many communities. Many of these houses that were built 30, 40, 50 years ago, they haven't been touched, and the opportunities are still there. It's just not low-hanging fruit anymore. Maybe real quick, Charles, because I want to get to predictions, a couple of ideas on how investors can find these deals that are out there today, maybe other than the MLS.
So yeah, I mean, social media can be your best friend or your worst enemy, as we all know. We have somebody in our office, all he does day in and day out is flush through what we call wholesalers. And these are folks that are combing probate court leads. These are folks that are going door to door canvassing these, boarded up, busted down homes in communities that are revitalizing, faster than we can complete the construction. So that's how we're grabbing a lot of our fruit now. It's hard work, but if we're still able to pick up something for $50,000 and turn it around for 180, that's a good day. If we're leveraging hard money to do that, it's an even better day. And we have examples of what those numbers look like when you do leverage, but it does take work. It's not as easy as it looks or is portrayed to be for those beginner investors that are on this call. But it can be done. It can be done in your own backyard, or if you're looking to do it in the Southeast because you're in Massachusetts, that's kind of what we're here for. Is again, we have been very fortunate that we were in a really good renovation market before this happened, and now it has just absolutely exploded on us. We've got a few Airbnbs that we own personally, that I own personally. Since March, we have had either a New Yorker, a Californian, or somebody from New Jersey in those Airbnbs every single week. So they're coming in droves. So it's a good spot to be in.
So folks, we're coming up on the top of I guess it's going to be 20 minutes after the hour. We've got a hard stop. So with that said, 30-second predictions. Steve, I know you've been jotting down vigorously over there. Where are we going on all things investment properties? 30 seconds, Steve.
All things investment, just getting bigger and bigger. It's another source of capital. Build to rent's growing. We're seeing massive inflows of cash from domestic, more sophisticated institutions, as well as international money. We're at the beginning, maybe second or third inning.
Great. Nathan, your thoughts?
And it's going up no matter how you read the tea leaves. Everything is going to be going up for a period of time. There's a lot of money back in all of that. The real trick is getting in touch with the investors. There's a lot of investors that can't figure out how to find you guys that have deals. And there's a lot of you guys that can't figure out how to find the investors without some of those networking, finding those qualified investors that can invest in your projects. Make sure you're attending. Don't give up. If you get a deal, get it under contract and go out there and go to some networking events, some live ones. You'll find them. They're out there. The money's out there. Go get it.
Perfect. Jennifer.
So I think they said it well. I think with the amount of capital that's been raised, both onshore and coming in from offshore, it's going to continue to be significant and growing. Now, I had a conversation with a very, very large public entity the other day, and they said, well, don't you think that single family rental is going to replace residential mortgage? And I said, no, but with that said, it is pretty big right now. But what I would say is I do think we should also pay attention to the pruning that's going to occur with some of the institutional guys that could bring some opportunities for some of the smaller guys. Because with build to rent, they are going to once again want to be able to consolidate their footprints to ample size. Okay, and as they start to build significant communities and whatnot with these builder partnerships, I think you're going to see assets that maybe they have had but they haven't finished, or also assets they have be sold off at more reasonable levels based upon the fact that they're going to look to move their boots on the ground to different places. So I would keep an eye out for that as well.
Charles, I'll give you 10 seconds. Where are we going?
Same answer. Sky's the limit. I think we've proven that fact through, obviously the elections always play a role, and this was the most extreme in history, I think, and we just blew right through it. We don't care who's president. We don't care what the administration's doing. If the rates are going up, they're not going up that much. It's a great space to be in for the foreseeable future.
Well, listen, everyone, thank you so much. I appreciate all the deep industry knowledge and the funding strategies. Really well done. Charles, Jennifer, Nathan, Steve, thanks so much for your time. I look forward to seeing you all, hopefully in person, in the not too distant future. Folks,
thank you all for participating. You truly bring a wealth of knowledge to the space. Have a great day.
So much.
Thanks, everybody.
Thanks, Suzanne.
We're heading into our next session. Give us just 30 seconds for a quick crossover. Hello, David, I see you. And I think you're muted. And hey, Rick, how are you?
I'm ready. Good afternoon.
Good afternoon.
Hey,
it's still morning for you, though, isn't it?
Yes, it is. Hey, Jeff, you've been doing a great job. That was a great panel.
I appreciate that, David.
I will bow out, Jeff, and leave it in your capable hands. Thank you so much, everyone.
All right. And welcome back, everyone. Thanks so much for joining us. We are on our final panel of the day. We're really going to be discussing services and strategies. We once again have put together an outstanding panel. So I'm just going to give everyone on the panel just a few seconds to introduce themselves. Ryan, welcome aboard from Keystone. Great to see you.
Great to see you. Thanks, everybody. This is Ryan Hennessy with Keystone. Happy to be part of this. Suzanne, thanks for coordinating and looking forward to the discussion.
Thanks so much, Ryan. David, as always, good to see you from Homevestors. A little bit about yourself and your company.
Thank you, Jeff. I am David Hicks, and I'm the CEO of Homevestors. Many people don't know the name Homevestors, but they know our advertising, We Buy Ugly Houses. We have over 1,150 franchises all over the country. And I tell you what, Jeff, with COVID, we are growing really fast.
Congratulations, David. Rebecca, I haven't seen you in quite some time. Good to see you again. What's going on at Radian?
Yeah, hi Jeff, great to see you as well and to be part of the panel today. I'm Rebecca Smith, Vice President of Business Development for Radian. I cover the asset management division, which is asset management, single family rental diligence, technology and acquisition. So I'm happy to be here and among all these great panelists today.
Thanks so much, Rebecca. And finally, Rick, it hasn't been that long since we've seen each other. Good to see you again. What's going on with Realty Track?
Yeah, we keep running into each other. It's almost like we're there in person, isn't it?
Yeah.
So yeah, Rick Sharga, I'm an executive vice president at Realty Track. If you're not familiar with Realty Track, we publish the country's largest database of foreclosure information, really used primarily by real estate investors and real estate professionals. So very happy to be here and be part of the discussion.
Thanks so much, Rick. Love the data. So finally, myself, Jeffrey Tesch, I'm CEO of RCN Capital. We are a nationwide platform for investors acquiring financing, whether it be bridge lending, buy, fix, and sell, longer term rental aggregation, 30-year debt on single family homes, also multifamily bridge and multifamily debt. And finally, we do have a infill ground up construction program across the United States. So good to be with all of you. And I'll tell you what, folks, buckle up because this is going to be an outstanding panel. David, I'm going to get right to you. Question number one for investors across the United States today: how do I aggregate homes? How are your franchisees doing it? Maybe some tricks of the trade.
Absolutely. And first of all, Jeff, I want to thank you. You know from the business that you're doing with our franchises. I think a lot of our franchises are doing a lot more business with you now than they were a year ago. So you know how our business is doing. The reality right now that we are seeing the inventory is so tight. A lot of people, a lot of investors are struggling to find houses. Now, the good news with us, we are not buying through normal channels. And so our purpose is the way we're buying houses, our advertising generates those people calling us. And so the good news about it, and we have watched through several crises now, whether it was 9/11 or the Great Recession or the COVID, the reality is people still have events that generate them calling our advertising through all of this. And that's one of the things the properties we buy has not changed much. What has changed is how we're selling them. And in fact, we're selling more to other investors now than we are retail because investors are searching for properties so much. And our franchises are buying them. We're buying real close to the same numbers we were a year ago. We're down slightly. Our sales price is up, which means they're selling for more, but we're buying pretty close to the same number of houses. In fact, we anticipate this month we've been 10 to 15% down. That means we're buying close to 10,000 properties instead of 10.5, 11 last year. Now we're going to be, we anticipate beginning this month, we're going to be higher than we were pre-COVID.
So that's interesting. More of your franchisees deciding to wholesale instead of running it all the way through rehab and then sale to an end user. How does that decision get made? Maybe some of the investors on the call today can benefit from that knowledge that your franchisees have.
Well, the reality is, Jeff, it's a math equation. It's an economics, and that there are so many investors trying to buy houses right now, they can't find them. And so when our guys buy a house, it's interesting, they are selling them to other investors and probably making as much, if not more, than they would fix it up and retailing it. Because the advertising generates the call. That's one of the reasons we're getting so many calls from people wanting to be franchises, because they can't find houses and they're still buying them for our franchise, and say, where are you getting them? And they say, how can I join you? And so we're getting a lot of, we've had record franchise sales ever since last summer when it started. So,
well, congratulations. Your model is truly remarkable and what it's able to do for the investment community and your franchisees. And I think that's a great segue to you, Rebecca, which is, you know, Radian has such a handle on title, valuation, asset management, the technology that you provide real estate agents. How are folks today making that decision of should I buy and rehab and sell? Should I buy and aggregate for building out my rental portfolio? You know, all these decisions have changed during the course of our pandemic here. What are you seeing, Rebecca?
Well, you hit it right on the head. We're in a series of change, and as they alluded on the previous panel, supply is the issue in today's market, with both whether you're fixing and flipping or holding a long-term strategy for rental. I think there's a lot of contention in what the environment is holding for us. You got to consider your holding costs. I mean, I really suggest the diligence include several layers of valuation. You're getting some of that bottleneck with, you know, distributors and suppliers. Obviously, that they just talked about lumber. I mean, just even trying to do some fix on any type of property right now, whether you're going to sell it or hold it, is going to be challenging in today's environment. So it really just depends on making sure that you're looking at all of the different avenues. Right now, with not being able to acquire properties at a discount, you just got to really look through all the margins. It's going to change swiftly, as we know. A couple months or maybe 6 months down the road, we're going to see quite a difference with the inventory picking up and a more availability for either option.
So when you say layers of valuation, maybe for our listeners today, talk us through what that looks like. What are best practices?
Well, some of the things we've been seeing is using all of the different automated tools. There's some, you know, usually starting with an AVM is a good automated valuation, just to kind of get a gut check on what's going on. It's really good to get dialed in with some local experts and real estate professionals. They kind of understand what's going on. They have a good finger on the pulse of what's in the current market that you're looking at, especially if you want to go nationally. There's a lot of resources out there. Looking at your home price index, there's several of those out there, and that's the data you want to be watching, because you're going to see all the ebbs and flows and at a macro level. I also think hybrid appraisals, different types of hybrid evaluations have really come to market with a lot of the digression of the asset class itself, with appraisers aging out and just having a scarcity of getting appraisers as well. So there's a combination, and we just suggest doing it at several layers, starting with something, you know, quick and nitty gritty, and then getting into, you know, your BPO valuations and some of your automated type valuation.
Yeah, and Ryan, I want to go to you on that decision making, but I'll just add, Rebecca, you know, at RCN, we've made that transition to the hybrid valuation with the refi boom in the conventional residential mortgage market. It became virtually impossible for us to be able to meet our turn times using the standard model. So at RCN, we made that complete model shift to a hybrid appraisal model under 500K, which is the majority of loans that we do, because we ran the models, and using that hybrid model, which basically means use an independent person to go take the pictures and do the measurements, but then you have the certified appraiser doing the model and it running the actual valuation. It's made such a difference for us in turn times and gave us a competitive advantage. That's really well said. And Ryan, I do want to touch with you and you know, listen, at Keystone, you are dealing with investors. How are they making that decision? Buy, wholesale? Do I aggregate for rental? What kind of advice and what are the decision points that you're providing the investment community?
I think the biggest thing is to be diversified in what you're attempting to do and where you're attempting to do it. Becca's right in having the resources there from a valuation standpoint. AVMs are a great base, but the one thing that they lack is giving you insight into condition, right? It's just data being pulled. So that at least gets you a start. Switching to something from to a hybrid appraisal isn't a bad idea, depending on what your long-term goals might be. You know, the average age of an appraiser is going up, and the number of those that are licensed to perform them is going down. So that tells you that that's just an aged profession. As far as advice on whether to flip or hold a long-term strategy, I personally have always liked flips more because I'd rather get in and out. That's more of a personal preference. What I'd advise is really a couple of things. One is to really look at your market and expand to follow the trends. What we're seeing a lot is migration of those from cities to suburbs, right? So maybe expanding your radius of the markets that you like to be in to consider those outer perimeters or even the next county out. Your dollar will go further usually in the suburbs than it does, you know, in the center of the city. Looking at different ways to maximize your own investments from or through partnerships. It's one thing to acquire and be the investor, but can you also now take equity in title companies from a local perspective? Can you partner more strategically with real estate agents or become one and save in some commissions? Can you work closer with lenders or builders or again, be certified as a GC to cut different costs as you'd invest? I think those are all ways to kind of squeeze more out of each asset when you have houses appreciating really at the level they are. If you are a flipper exclusively, considering rental goes against usually what I just said about me personally, but ultimately that's not a bad idea because with the level some houses are appreciating, it almost questions affordability for your average home buyer. So they might be more apt to rent a nicer, more luxury home because the down payment based off where that loan would come in at is just, it's not feasible if they've had a hardship from the pandemic or something to that effect.
Yeah, I love some of those ideas that you have on ways to save costs or potentially increase revenue streams, such as, you know, if you're using a real estate agent and you've gotten to a certain size, maybe you think about bringing a real estate agent in-house. Have you seen a transition from this during the pandemic? Have more folks become maybe a little sharper with their pencil than they had been?
Absolutely. I mean, you have to be. It's been, I guess, a common theme throughout the discussions here with, you know, if you're investing in a house, whether it is for rent or to resell, it can only be worth so much. I mean, if the house is 2,000 square feet, 3-bedroom, 2.5 bath, there's certain things, certain luxuries you can put into that home. But at the end of the day, you're not changing its square footage. It's still in the same school district. It's in the same, you know, it's on the same lot size. If you're in California where Rick is, that's probably the same square footage, the lot size in the house, right? There's no property there. But you know, there's a lot of factors you can't control. So with raw materials increasing, you know, that impact really your investment in the asset, you have to be sharper, you have to be more innovative, you have to be a little bit more clever with how you're approaching things. You know, whether that's something simple and just negotiating with your lender, or having different lending products available to you from different folks, depending on what your goal is for that asset, all the way through and bringing certain functions in-house if you are of size or moving different markets.
No, I think that's well said. And we're certainly seeing that on our end at RCN, whereas folks are pivoting. In other words, they're getting in and they're running the numbers up front. And Rick, I'm going to want to get to you about numbers, but they're running the numbers up front and they're saying, you know what? We thought we were going to flip this property, but when we see what the potential return on investment is, especially with the rates that you can lock in today, I mean, it's just amazing. We're locking people in. You know, they buy the rate down into the high threes. You know, we did a loan just on Friday, 3.85 for a 30-year fixed mortgage. It's an incredible return on investment. I think that's very well said about deciding how you're going to do the process up front by trusting the numbers. And Rick, you know, the numbers today are certainly bearing that out. Maybe you could talk with our investors today a little bit about what you're seeing and how folks are making these decisions up front across the U.S. What numbers are you seeing, Rick?
Well, the two numbers that have been top of mind for everybody, of course, have been the escalation in home prices. Home prices have been appreciating in double digits now for the last year, which is, you know, unsustainable in the long run. But that, to a certain extent, has been offset by historically low mortgage rates. And in fact, if you look at the numbers published by the National Association of Realtors, there's only one state in the union where the average mortgage payment went up year over year, in spite of the fact that home prices escalated by 10 to 12%. And that, of course, happens to be the state Ryan pointed out earlier here in California, where home prices have escalated even more rapidly than they have across the rest of the country. So people, to your point, Jeff, really do have to sharpen their pencils. And at the risk of being a little self-serving, that's one of the reasons that so many people do look for distressed properties, do look for properties in various stages of foreclosure. The one thing I would point out for investors who are looking for these kind of off-market properties is I believe this cycle is going to behave very, very differently than the last housing boom and bust cycle that we lived through back during the Great Recession. If you remember back then, the market was overbuilt. When the mortgage market began to implode, home prices dropped across the country by 35%, in some states 50 and 60%. Nobody was lending. And so everything that wound up going into default ultimately became a bank property, an REO, a lender-owned asset. So investors were smart to stay on the sidelines, keep their powder dry, and wait for the lenders to repossess those properties. I really don't think that's going to happen this time. There's a record level of homeowner equity, about $6.5 trillion. The equity reports we do here at Adam Data show that 70% of homeowners have more than 20% equity. And Black Knights issued some reports that even the people in forbearance, by and large, over 90% of them have more than 10% equity. So I really think for investors looking for these below market, off market deals, they're going to have to reach out to homeowners in the earliest stages of foreclosure and try and buy the properties before the foreclosure auction, because I believe the overwhelming majority of those distressed assets are going to move that way. That's where David's franchisees will be living for the next year and a half. As Becca said, we're going to see a bit of a surge when these government programs expire. And there are going to be a lot of opportunities for both fix and flip, buy and hold, and even wholesale investors once the market shifts.
So I think that is a great data point for our listeners today, which is there is a presumption with a great, we'll say a fair number of investors across the US, and we talk to them on a regular basis here, which is just wait till that foreclosure moratorium comes up. You haven't seen nothing yet, right? So for the investors across the US, just double down on what you just said about the amount of equity and how it's going to be very different this time around.
Thank you. This is really important to get out to investors across the country. We are not capital letters, underlined, bold, red face type, not going to see the kind of foreclosure tsunami this time that we saw last time. There are about 2.5 million borrowers in the government's forbearance program. Of those borrowers, the ones who have exited since last June through February, 86% of them have exited successfully, which means they've kept making their payments, they've had their loans reinstated, they've entered into some sort of loan modification, they've paid off the loan, all positive events. And the way the program is set up, there is no lump sum payment due at the end of forbearance. So if those numbers hold, that means 14% of the people in the program really are at risk of default. that would work out to about 350,000 borrowers. There were about 250,000 people in foreclosure prior to the moratorium, prior to the forbearance program. So if you add them all up, you wind up with somewhere between 500 and 600,000 people in foreclosure over some period of time. They won't all hit the market at once. To put that in perspective, that's about 1.25% of all mortgages being in foreclosure. The normal level is 1%. So we're only about 25 basis points higher than usual. And at the peak of the foreclosure crisis back in 2008 to 2010, we were at 4%. So the numbers are going to pale compared to what we saw before. We'll be getting back to normal, a little bit more than normal. And again, most of the borrowers who do find themselves in financial distress will be more inclined to sell the property before the foreclosure auction rather than lose everything to foreclosure. But there are going to be opportunities for investors to reach out to those people. In most states, somebody can avoid a foreclosure right up until the sale takes place at the courthouse. And so investors who have financing ready through somebody like RCN or have cash available to go in and make those purchases will be able to go in and create a real win-win situation. They'll be able to get a property at something of a discount and help that homeowner avoid a foreclosure. So we're not going to see millions of foreclosures. We will see an increase compared to where we were before the pandemic. We'll be getting back to a little bit more than normal, but we're not going to see the kind of tidal wave of foreclosures we saw last time.
So Rebecca, I got to let you jump in on this because certainly Radian, you know, certainly through the last crisis and working through those defaulted loans and all the way through, your model is built for handling something like this. I got to have you chime in on what Rick's saying here. Have you thought through this with your company, and how does it play out for investors?
Sure. Yeah. I mean, things look a little different, and I agree with Rick and what we're seeing and what we expect, but we definitely are prepared to assist our clients with those that will have some. I mean, I think that's the biggest thing for investors, to identify which clients have the inventory, even down to the local real estate agent. You start gaining some relationships with your local real estate professionals. That's where you're going to get the inside track on some pocket listings or upcoming listings, and firms such as ourselves that manage assets for, you know, a myriad of clients that are in default. I think we look at it that there's still always going to be a need for asset management. Like Rick alluded to, there is still a number of default that it was already in the pipe. Once the flip switches, it's just going to move through the pipe. Then you're going to see a little bit of uptick, and then it's going to just normalize like what we've always seen. So we're here for it. We're ready, and I can't say we're looking forward to it. Certainly we don't want, no one looks forward to having that, you know, a default, but we're definitely here to help the clients to navigate that.
Yeah, so David, I have to go back to you, which is, and your model is so sophisticated, the HomeVestor model, the education that you provide for investors across the US, your franchisees. How have you taken this knowledge on what we're expecting in the slight uptick of foreclosures and are really giving your franchisees the tools to be able to buy those houses? I mean, I think that's where the rubber meets the road with our callers today.
Yeah, great question. And I want to add on to something that Rick said. The second part of that, even though there's foreclosures coming, the other side of that is there is a real lack of inventory. I saw a stat that there's half the lowest level of inventory there's been in the last 5 years of single family houses for sale, half. Yep. And so the other thing that's going to happen, even though there are some of those, all they have to do is list them, they'll be gone. I mean, I think right now there's such a lack of inventory, those foreclosures are going to be sucked up by the demand that's already out there. And so I think you will see those investors waiting on foreclosures may be surprised. There may not, and I agree with Rick, there may not be that many hit the market on doing it. And so one of the things that we are franchises right now, the reality is that's why we have never looked at foreclosures. We have never counted on them. Even in 08 and 09 and 2010, we didn't buy foreclosures. We're buying from sellers that really have a house to sell. That is their house, and we're buying it. Sometimes it's stressed for those that may be under stress for foreclosure, but even that is not that much of the issue. It is not that. Now, I will also add with investors, one of the big fears we have, and one of the things, Jeff, when they're doing a value, our franchises, if I go back to March of last year, when all this hit, everybody was across the market said real estate's going to crash. I mean, our franchise at first were afraid to buy, but very quickly something happened. They learned from each other, and I think the best sign our franchise have, and the best advantage they have, is they have ability to learn from others. 1,100 other investors buying houses, and everything they were selling was selling above market price. Everything. And so very quickly, I mean, within a matter of weeks, our franchise were saying, hey, forget this, we're buying. And they went aggressively buying houses, and we bought through all of it. I bet there was a 2-week time frame when we were doubting it, but from then on, they were buying and buying aggressively. That's why our numbers held so much. And I would say that the other thing's going to happen. The market is going to slow down. And I would challenge investors on the call that they want to be careful of. Right now, if they're counting on appreciation to cover the value of the house they're having, they don't know when it's going to dry up. And they want to, because it is going to slow down. And it cannot, and I think Rick said it is unsustainable at the level it is. And so if they're counting on that appreciation to support the price they're doing, they need to be real careful with that.
So yeah, I'm going to pivot back to you, Rick, right? Like how do investors think through that unsustainable? How do they think through when the music stops, where am I going to be, right? Like
absolutely. Well, that's one of the things, and I think Ryan was saying he goes away from rental properties. They want to sell it, fix and flip. If you're buying a house that's overpriced, sell it quickly. You need to do that. What we caution franchise, look for in that area, and they work together as a council and a group to understand the value. If they're going to keep a rental property, they need to understand the value of that property long-term and be willing to be in it for long-term. And they need to look, and it's real careful. One of the things you have to be careful of, and I agree with what Rebecca was saying on values of the layers of valuation. One of the things they have to really look for is make sure they're not going too far back. Make sure their value they're doing. I see a lot of mistake investors do is they go look for data to support the value they think this house has to buy, instead of going and looking for data to establish the value. What is the true value of this house? If they buy the house at the right value, they're probably pretty safe. Where they get in trouble is where they go, I want to go find enough data to support the price I think I need to pay to buy this house. Instead of looking for the data, is this house worth what I'm going to have to pay to get it? If not, don't buy it. And if they are doing data from that way, they're pretty safe. But when they get in trouble, and if we go back even, we've been through 3 or 4 little downturns since I've been in the business and since the company's been here. The ones that get in trouble are the ones that push it at the point where it's going up a lot and it slows down or goes backwards a little bit. We don't think it's going to go backwards. It's inevitable it's going to slow down.
Yeah, that's some great advice for investors, David. I appreciate that. And Ryan, I know in your business, at Keystone, you've got to be thinking through some of the things that we're talking about today, which is when assets become available again, and maybe, take a stab at it from an investor standpoint, some best practices on how investors should be thinking through things when these moratoriums are lifted and the foreclosures happen.
I think in order for investors to really, position themselves, they kind of have to understand what's going on in the servicing world. When Rick, we were on a discussion quite some time ago, and the one thing that you mentioned that kind of resonated with me was the biggest difference, the two biggest differences really between now and about 2008 was, one, a larger percentage of loans are government backed than they were previous, and two, this is really a global crisis, not caused by the housing market itself, right? So what happened as a result of 2008 in the servicing world is that process to service a delinquent loan through foreclosure went from a three-legged race to a very linear process. And what I mean by that is when a loan first went delinquent, collections, loss MIT, and foreclosure were all triggered at the same time, essentially, and whichever department won the race to their respective finish line is or was the outcome of that loan. Now, what has happened since, with regulatory governance over the process, additional rights for borrowers, so on and so forth, you have to exhaust collections, loss MIT, and then foreclosure happens. So not that the process takes longer, it's just a different approach as to help borrowers along any mitigation efforts. So what's happened since the pandemic? Well, initially with forbearance and moratoriums on the foreclosures, a lot of servicers, institutions applied a lot of resources to their loss MIT departments. Such an influx of calls that at least I became aware of through our clients in the forbearance plan, looking to refi to lower their payments, just kind of some out of necessity and some out of, if I can take advantage of some of these programs to lower my cost as to maybe avoid something in the future or the unknown, let me try and save some money now. The big trend that we've seen since then as well in these servicing shops is really applying a lot more analytics to what's commonly just referred to as best execution. With most of these loans being government backed, there's potentially a choice as to what path you're going to take come foreclosure sale. Are you going to take it to REO? Are you going to convey it? Or are you going to sell it third party? They can all yield different results to the servicer and or owner of the debt. With the servicers, the institutions becoming a little bit more intelligent with the data that's being provided to them, it doesn't so much imply that REO is discounted properties anymore. We did a study about 2 weeks ago on our USDA inventory that we sell, and I can't tie everything back to the actual loan itself because we're only privy to so much data, but the net asset recovery was 103% of sale price, meaning that servicers or their sellers were recovering more in net proceeds, or recovering net proceeds higher than what they're selling the property for, which doesn't really make sense when you think, okay, we got 10% tied to commissions and title and transfer. I have costs to carry the property, preservation, maybe eviction costs, so on and so forth. But between the USDA's adjusted claims process and appreciating housing markets, even in the rural or tertiary markets, they're going to be smart about how they approach this as well. With how they're liquidating inventory. So there's kind of a bifurcated asset class, I think, is a quick determination of properties that are worth the time of the asset holder, and they'll either not invest in it to the level of the audience from a renovation perspective, but invest time, if nothing else, into selling that property a little bit more high touch. And then those properties that are just from their perspective at a national institutional level, just not worth their time to, serious mold damage, structural damage, serious condition issues. And I think, those properties, albeit really the low of the low from a use case perspective, might take the most in investment, are where a lot of opportunity will lie for investors going forward. Kind of the higher end, almost turnkey REO that you could get for 60 cents on the dollar a decade ago isn't going to fly right now. It really has to be a serious level of distress to get a steal in a market that you might not be as comfortable with. But again, with what everyone said, the layers of values, the data, the partnerships, the sharpened pencils, the additional homework that you can do, it's going to be worth somebody's time because these properties are inevitably still trading.
Well, that's super interesting, right, Rick? The thought that REO no longer means discount, right? I would love for you to say just a few thoughts on that, right? Because I think a great deal of our audience, because we hear it all the time at RCN, REO, the REOs are coming. It's, you know, what Ryan is saying is REO does not mean discount for the most part anymore. Go ahead, Rick.
Well, the irony is your discount might be paying 100%, which is better than 103%, or it's 100% in today's market in an area that appreciation has been going at 8 to 10% annually. And I would echo something David said. I would hesitate to bank on appreciation as my means for profit. You really do have to sharpen your pencils as an investor and look at these things. But that's Ryan and I are on exactly the same page. I think there will be fewer REO, and I think referring to it as a bifurcated market is absolutely spot on. You're going to have your scratch and dent inventory that will sell at a discount. Probably not as much of a discount as it would have 10 years ago, but it will be discounted. And where investors get themselves in trouble there is not accurately estimating repair costs to take it to market. The other side is going to be properties that the lenders decide with a little bit of fresh coat of paint and some carpet, they can sell at almost full market value or better, and you'll see that going on. People, if we're looking in the distressed part of the market, need to think in 3 layers. They need to think pre-foreclosure, where they're going to work directly with the homeowner and try and negotiate something that's maybe a little bit below market in order to be able to flip that property or buy it at a reasonable rate. They'll have to look at the auctions, which is that's a whole different webinar. We'll talk about that one later. Or they have to look at this REO inventory, and the REO inventory, to Ryan's point, will not be as inexpensive as it used to be. And going back to an earlier question of yours, Jeff, a lot of this comes down to your personal investing strategy. Are you a flipper, a wholesaler, or are you going to hold it for rent? And if it's the latter, you're probably a little less price sensitive because your horizon's longer and you're looking to make your money in cash flow as opposed to home price appreciation. If you are a flipper or a wholesaler, you really need to be buying as low as possible. And that opens up a whole different category of valuation and investigation and strategy to find those off-market properties that you can acquire at low enough so you get a reasonable ROI.
Well, with that, we've reached the top of the hour. And I'll tell you, the tidbits and the strategies that came out of this panel today, investors, I really hope you jotted some of these down, because at the end of the day, these experts are outstanding prognosticators
That too.
on where this marketplace is going. And I'll tell you, David, thank you so much. Rick, your data amazing. Ryan, I can't thank you enough. Rebecca, thanks for all you do. Suzanne, I'm going to toss it back to you. This panel's been outstanding today.
Thank you,
I want to
Jeff.
thank everyone so much for participating. For those that are on the call, we will be posting a link to the full webinar series of all 3 sessions, but you guys have been tremendous, and I thank you for your industry dedication. Have a great day, everyone.
Thank you.
Thank you.